There's no, hardwired deadline. We are doing the work of legislating. This is a big week.
It is a relationship in trade that has been marked by significant imbalance. That is in terms of performance, but also in terms of opportunity.
If you own a Bitcoin today, you will be a millionaire in the future, for sure. Congratulations.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning and welcome to Bloomberg Surveillance, the Early Edition on this Monday, the 7th of June. I'm Francine Lacqua here in London, and here's what's coming up on today's program. G7 nations agree a minimum corporate tax of at least 15% in a landmark deal that could see governments outside the U.S. impose levies on tech giants such as Facebook and Amazon. Treasury Secretary Janet Yellen says higher rates in the U.S. would be a plus for both the Federal Reserve and the nation as a whole. And NatWest Chairman Howard Davies joins the program shortly as Boris Johnson and Rishi Sunak summon UK finance chiefs to discuss their role in the post-pandemic recovery. So let's get straight to our top story. G7 nations have agreed to revamp their tax rules, including a minimum corporate tax rate of at least 15% on foreign earnings. Now, the landmark deal may help countries collect more revenue from big digital firms.
The G7 has taken significant steps this weekend to end the existing harmful dynamic, making commitments today that provide tremendous momentum towards achieving a robust global minimum tax at a rate of at least 15%.
I think the crucial thing for people to take away is the principle of fairness. That's what we've achieved today to ensure that there's a level playing field for all types of companies. And whether it's people operating in tax havens or it's digital companies, we're going to level the playing field and inject that principle of fairness into our global tax system.
Well, that was U.S. Treasury Secretary Janet Yellen and UK Chancellor Rishi Sunak. Now, joining us is our chief Asia economics correspondent, Enda Kearns. Enda, how important is this deal and what does it actually mean?
Well, clearly, Francine, look, it's a big step forward in this debate. It's been going on for quite a while now. On the one hand, it's an agreement to tax these, especially these big technology companies, on where they earn their money, not just where they're based. And of course, it will help pay for the pandemic. Let's not forget that governments have borrowed over 20 trillion since the pandemic began. So that whole borrowing binge has accelerated the need for this tax agreement in the first place. It's an example of a multilateral agreement. We haven't had one on this scale for some time, and you see how the technology companies are reacting to it. They're giving it a kind of a cautious welcome, so to speak. So I think by all accounts, there's no doubt it is a step forward. It is a big bringing together of the world's richest economies, but clearly there's still a way to go, Francine, before this does get across the finishing line.
So what comes next in the process, Enda?
Well, I think this is now where the devil gets into the details, so to speak. We know that there's a broad push for this now. There's a broad consensus for it, but there's still some detail to be worked out around what level exactly. I mean, France is still talking, for example, about a higher level. There is the issue of getting it ratified at national parliaments. There's some opposition on both sides of the aisle in the US. For example, we have the G20 finance ministers meeting coming up this month. That will be one to watch because that's, of course, a broader audience than the G7. Then you push into the OECD track. So there's certainly a way to go yet in terms of getting all of these governments on board and getting all of the details signed off. And then, of course, implementation itself will take years. But to be clear, Francine, at the very start, there has to be said, it is a significant agreement, and it is a coming together of governments on a major economic issue, the likes of which that we haven't seen now for some time.
Enda, thank you so much. Our chief Asia economics correspondent there, Enda Kearns. Now let's also talk about inflation because the Treasury Secretary Janet Yellen has weighed in once again on the inflation debate. Now, speaking in an interview with Bloomberg, she said President Biden should push forward with his spending plan if they trigger inflation that persists into next year and forces rate hikes, which would be good for both society and the Fed. The former Bank of England governor, though, Mervyn King, writes in his column for Bloomberg Opinion this morning that the risk of inflation is real. He says we can't know if inflation will rise over the next few months or a few years, but the prospect should actually make us nervous. Well, joining us now to talk about inflation, tax, and much more is Sir Howard Davies. He's NatWest Group Chairman, a former Deputy Governor of the Bank of England, as well as the Director of the London School of Economics. He was also the first Chairman of the Financial Services Authority. So, Sir Howard, thank you so much, as always, for making us a little bit smarter on all these global issues. First of all, there was a landmark deal on tax. Does that actually change the way that countries will operate amongst each other and companies really taxed, or are there going to be processes that make it much more difficult than it looks on paper?
Well, your correspondent was right that there's quite a bit of work to be done since after this agreement, because the G7 is, 7, and there are plenty of other countries out there. Now, you may assume that with some of the biggest other countries, they've probably done some pre-cooking of this. But it will be hard to get it through both in Europe and more broadly, because there are some countries, Ireland being one, which have made considerable play of their low tax environment. And that's going to be a bigger change for them than it is for the UK. So there is quite a lot of work to be done. But it is significant that the US have been prepared to do this deal, or to announce this deal, because in the past they've not been prepared really to exert themselves on international tax questions. So that's the biggest, most significant change, I think.
When you look at inflation, I don't know how much we should worry about inflation now. And it goes to the big debate, Sir Howard, of the people like Janet Yellen that say, look, this is transitory because of the pandemic. And then the critics that I guess worry that because of this infrastructure plan and this huge spending from the US and elsewhere, we're going to have, fast rising inflation that's here to stay.
Yeah, I think the US are being a bit confusing here. And I think it would be good if we heard one message from the US, because on the one hand, you've got Janet Yellen actually saying, well, maybe a rise in interest rates would be a good thing. And as a banker, I could hardly disagree with that. That would actually be quite positive from a bank's point of view. On the other hand, you've got the Fed saying, well, we are going in future to adopt an average inflation approach, whereby if there is an undershoot of our 2% inflation target for a period, then we will compensate for that by allowing inflation to be above the target for a period. The difficulty is that they haven't said when the period starts. How far back do you go in looking at what past inflation has been? But in fact, if you think that through, it's not the same as what Janet Yellen is saying, because what the Fed is saying is we may not raise rates and allow inflation to be higher than the target for a period, whereas she's saying, well, higher rates might be a good thing. So I do think this is a bit confusing for the market at the moment, and it would be quite good if we had one consistent message from the US.
But Sir Howard, is it maybe then a message from Secretary Yellen saying actually, the Biden administration will stick to the $4 trillion spending plan no matter what happens?
Well, the trouble is it's slightly back to front, because it's normally the Fed who talk about interest rates and the Treasury who talk about spending. And now you've got the Treasury giving an interest rate forecast, which, as you know, Francine, in Europe and in the UK would absolutely not be done. I mean, there'd be huge alarm if Rishi Sunak started talking about interest rate policy, or indeed, Macron started talking about interest rate policy, because those are central bank things. So there's a confusion about who's saying what and why, and I find that rather difficult.
Sir Howard, how do you see the recovery taking shape? Is it going to be a stronger recovery than we thought? Or are we getting ahead of ourselves and crying victory?
I am quite bullish at the moment from what we are seeing at the bank and from what the Bank of England are saying. I think that we can expect that quite a lot of the spending that was foregone last year will now come through quite quickly. Now, it'll be largely consumer spending, but the Bank of England estimate that people have saved about 10% of their total annual expenditure. And if they only spend half of that in the next 6 to 9 months, that's a big boost to consumer spending. So in the short run, I am quite optimistic about the bounce back. And you can see indications of that in the housing market. You can see it in the labour market with vacancies rising. The bigger question is where we settle after that, because what we found in the last global financial crisis was that we did have a bounce back, but then we settled back to a trend growth rate which was lower than the one we went into the crisis with. So the bigger question, I think, is will we come out of this and start to grow more rapidly on a consistent basis after this immediate bounce back? And the trouble there is that we haven't seen investment rise yet, because that's been the key failing, I think, particularly in the UK, but elsewhere as well, that investment has been relatively weak. And unless investment picks up, it's hard to see why we would end up with a sustainable growth rate that's larger than the higher than we went in. So I'm, optimistic in the short run and a bit cautious in the medium term.
And so why do you think that investment hasn't picked up, Sir Howard? Is it, chief executives being especially cautious because of variants and I guess the uncertainty of further lockdowns, or is it something deeper?
I think it's something deeper because it is something that's been persisting now for quite some time. The UK has had a lower investment rate than any other G7 country for a decade. So it's not just a COVID point, nor is it just a Brexit point. I mean, some people have said, well, it's post-Brexit investment has been weaker, but it seems to date back further than that. It just seems that somehow the domestic companies in particular, because inward investment's been relatively strong, are not disposed to invest. They're not confident about the profile of demand in the future. And that's the problem that we face in the UK. And so far, we haven't cracked that.
Sir Howard, thank you so much. Howard Davies there of NatWest Group stays with us, and we'll talk a little bit more about actually the UK situation and banks as well. Now, coming up, Boris Johnson and Rishi Sunak summoned the UK's top finance chiefs for a discussion about the City of London's role in financing the pandemic recovery. As ministers cast doubt over the country's planned reopening, we'll have a full conversation with Sir Howard about that. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the UK's finance chiefs will sit down today with the Prime Minister Boris Johnson and Chancellor Rishi Sunak as the government seeks assurances about the sector's commitment to financing the post-pandemic recovery. Now, this as government ministers threw doubt over the weekend on England's reopening date of June the 21st. Now, more than a dozen bankers, including Barclays Chief Executive, the LAC Chief Executive and NatWest Group Chief Executive, will attend the meeting. Executives are also set to discuss how best to maintain the UK's competitiveness in fintech and the burgeoning green finance industry. Well, we're back with Sir Howard Davies of NatWest Group, who's still with us. Sir Howard, thank you so much for staying with us. So, first of all, when you look at the relationship between the government and the banks, how's it going? It seems that, very different to 08, the bankers are now seen as part of the solution to the recovery.
Yes, the government has said that, which is nice. And so, yeah, I think there is a collaborative relationship at the moment, and there aren't really any main huge issues. I mean, the government are consulting on the bank tax surcharge, and you won't be surprised to know that I think that should be reduced. But the fact that they're consulting on it is positive in itself. There aren't really any huge issues with the Bank of England on regulation at this point. The bank have changed their view on dividends, so we're allowed to pay dividends again. So whereas 12 months ago, I think I'd have listed a litany of issues where we were somewhat not at one exactly with the government and the bank, that's not really the case. The big issue now, of course, is financing the recovery. I don't think there's a big issue on the personal side because, as we've just been saying, individuals have saved a lot of money, so they've got money to spend. On the corporate side, we're ready to lend. The issue, again, as I've been explaining, is whether there'll be enough investment demand. So I think that's the big question. How can we get investment demand moving?
Sir Howard, what exactly is the main message from NatWest to the government? So I know there's a number of questions from the Chancellor, including, fintech, green finance. What do you want to make sure that authorities listen to?
Well, I think that our position is probably be the same as many other businesses, which is that we think that an environment of some predictability is important, and therefore that people should have a clear view of a kind of roadmap to reopening, and recognizing that things can change, what would need to change in order for that roadmap to be amended. I think that kind of certainty, not absolute guaranteed certainty that things will open at a particular time, because we understand that's unrealistic, but an understanding of what the factors are and what makes the decisions about whether things get opened or not. And as you've heard, the travel industry is not happy that those decisions have been particularly transparent in the past. So some certainty is required. I think also from a finance side, we would like to see the signs that the government has a plan to deal with its excess debt over a period, not in the short term. I don't think that's appropriate now, but how will taxes be adjusted in the future? And just corporation tax doesn't seem to me to be a likely solution for the long run. So the government's going to have to find some way of replacing fuel duty, which is clearly declining, and some way of balancing the books. So some certainty there as well is helpful. But I don't think this is a moment at which the government and the banks are at loggerheads on any big issues. This is a free and open discussion about just how best to finance the recovery that we all want to see.
And Sir Howard, when you look at actually the Brexit and London, how can London remain competitive?
Well, yes. I mean, my view is that London still has a very important role to play in financing Europe, but largely as its offshore centre now, rather than a purely onshore centre in Europe, which is what we've been for the last 20 years or so. Now, the individual industries, sectors of finance will have particular shopping lists. The insurance industry, for example, would like to see some reforms to Solvency II. The banking sector is not demanding a lot because, of course, much banking regulation is in fact global, not European. The main rules on bank capital, which are the most important thing for banks, emerged from the Basel Committee. The European Union is represented there, but so are we, so we always have been. So I don't think that it's an issue there where you say we leave Europe and therefore we change our bank capital regime, because our bank capital regime is a global regime. So I think it's more in the areas of the stock market. There have been some proposals for making listings easier in insurance, for Solvency II, where it is possible to consider some changes in the UK which are different from the ones we have in Europe. But on bank capital, which is the most important thing for banks, it's global. So there's no point in trying to pretend that you can gain some advantage in Europe by changing it.
Wonderful. Thank you so much for all of your insight. Sir Howard Davies there, NatWest Group Chairman. Now, coming up a little bit later on Bloomberg TV, after G7 nations agree a landmark tax deal, we'll speak to the OECD Secretary General. He's Matthias Cormann. That's coming up shortly. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The UK Health Secretary Matt Hancock says it's too early to say whether a planned easing of coronavirus restrictions on June the 21st can go ahead. Ministers are continuing to weigh the threat posed by the rise of the Delta variant, first identified in India. The government says the variant is about 40% more transmissible possible than the previous dominant strain. Now to Germany. Armin Laschet has boosted his chances of succeeding Angela Merkel as Chancellor by securing a decisive victory in the country's poorest state. He led the CDU party to 37% of the vote in Saxony-Anhalt, according to projections from public broadcaster ARD. The far-right alternative for Germany slumped to a distant second in the former communist region with 22%. China's exports continued to surge last month, fueled by strong global demand as more economies around the world open up. Exports grew almost 28% in dollar terms in May from a year earlier, below the pace in April, but still well above historical growth rates. Imports soared 51%, the fastest pace since March, driven by higher commodity prices and last year's low base. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. A lot going on in the markets. Actually, it's going to be a big week because, of course, it's ECB, and then we had that landmark deal in London over the weekend for a tax. So we look at some of course, the companies that this could affect. It's mainly the big tech companies. And then overall, we're just waiting for more news on inflation. The tax plan, of course, in view, the dollar ticking up. You can see in general, U.S. equity futures dropping. A little bit of pressure also on some of the European equities as well. Coming up, more on the tax deal. G7 nations agree a minimum corporate tax of at least 15% in the landmark deal. NatWest chairman Howard Davies tells this program that it will be hard to implement beyond the group of seven. Treasury Secretary Janet Yellen says higher rates in the U.S. would be a plus for both the Federal Reserve and the nation as a whole. And Angela Merkel's party wins a decisive victory in the final electoral contest before her successor is chosen in September. Well, good morning, everyone. Happy Monday. First of all, it is Monday, and we have a packed week ahead. I'm Francine Lacqua here in London, and welcome to Bloomberg Surveillance Early Edition on this Monday, the 7th of June. Now, G7 nations have agreed to revamp their tax rules, including a minimum corporate tax rate of at least 15% on foreign earnings. The landmark deal may help countries collect more revenue from big digital firms. Well, the NatWest chairman told us earlier that the plan will be hard to implement before or beyond the group of seven. Well, joining us now from Brussels is our Brussels correspondent, Maria Tadeo. Maria, great to speak to you on this Monday morning. So what are the details on the deal exactly?
Yes, Francine. So this is now being hailed this morning as this new taxation, this tax revolution for the 21st century. Of course, a lot of this has to do with the digital companies. There's an agreement, as you said, on the rate that's at least 15%, but also the idea that companies now will have to pay in the countries where they make their money or they sell their services. For a long time now, there had been criticism that they were kind of shifting and flipping profits to low tax jurisdictions. This would avoid that. But Francine, going back to what you said, the implementation risk of this remains very high. This was an agreement by the G7. This will have to go to the G20 and ultimately also go to the OECD. And you can expect that there will be pushback from countries that are competitive on the taxation and want to continue to be so. So again, it's not very clear that this will happen overnight.
So what's been the reaction from some of these big firms, big tech firms, that will eventually have to pay more tax, Maria?
Yes, and Francine, it's interesting that we did get reaction. It was very quick, and it was also more positive than you would expect. Now, we heard from Facebook and Amazon. They said that they welcome the clarity around it, that they welcome the fact that there could be a single tax internationally that is recognized by all countries and all different companies. For them, I would argue, over the past few years, there has been this coming to terms with the idea that they will have to pay more, in particular in Europe. And, they're now coming to terms with that. It's more about the clarity on the rate and who gets to tax what. If that means that there is a global consensus for them, it's a move that they would prefer over many different national regimes.
Thank you so much, Maria Tadeo, there in Brussels for us. Now, we're just also getting some breaking news, and this is 220 million euros that have been, or Google has been fined $220 million, actually euros. I'm getting all muddled up between the dollars and the euros, but in my calculation, 220 million euros is equivalent to $268 million. So it all adds up. So they're paying now 220 million euros to settle France's probe of Google's abuse of power in online advertisement. This is after the French authorities put on this antitrust case over online advertising. They seem to have settled, and that's the fine, 220 million euros. Now, joining us to talk about the latest on the markets, to talk about Bitcoin, of course, futures and everything in between, is Eddie van der Veld. Eddie, you survived the CFA, which is good news. Now it's the wait to see whether you get it, but congratulations on that, because I know it's been a long slog and we've missed you on TV.
Congratulations after the results come. Let's wait. Let's not get carried away. So
well, you're still in one piece, Eddie.
I'm not
so
counting any chickens just yet. So,
Eddie,
listen, no, but it's great to be back. So, yeah, markets. I mean, Europe had a really interesting start. We saw this this lurch lower in European markets early on, and that was quickly erased. Some of that was on oil prices, but I think there's just a little bit of uncertainty about what these tax changes are going to mean, and people are just trying to price in, exactly what to do around these things. Some of this has been a long time coming, but I also think there was a lot of people that didn't expect the breakthrough at this moment in time.
So, Eddie, I mean, let's talk about crypto, because it's been pretty wild. And, I've been dying really to get your thoughts on everything from Ether to Doge to kind of the Elon Musk tweets. But is this still, becoming mainstream, or because of all the volatility, like literally by tweet, do you think asset managers are slowly shying away or taking a pause for breath?
There was something really interesting that happened over the weekend. We saw Bitcoin fall substantially, on this pressure out of China, which seems relentless at the moment. But at the same time, you saw Ether hold up fairly well through most of it, right? And I think what we're seeing from the fund managers is we're seeing a little bit of a repeat of 2016, 2017, where people are saying, look, I don't really think Bitcoin's going to replace the dollar, but I do like the blockchain technology. And Ether seems to be the leader in that. Ether seems to be able to adapt quicker than Bitcoin. And a part of that is just because Bitcoin is not, it's still treated as a kind of quasi-religious. Its early texts, the white paper and the Satoshi Nakamoto, who's absent, makes it very hard for the cryptocurrency to change as change is needed. And technology comes with change, and I think this is giving Ether the edge. And so I think, but I do worry about this echo of 2016, 2017, where everybody's saying it's not Bitcoin, it's the blockchain, and that's what we saw just before the collapse last time.
Eddie, a lot of the focus today, of course, is on what Janet Yellen said about inflation. Now, we had a good conversation, actually, with Sir Howard Davies that was saying, the message from the U.S. is confusing because this is the finance minister now talking about rates going up. And we tried to, figure out whether this was just a signal that the Biden administration, no matter what happens with inflation, will stick to the plan. But actually, how the markets take this, it's once again, Secretary Yellen kind of maybe going into territory that she shouldn't be waging on.
Absolutely, and I think it's a very dangerous situation in the US. If you've got this sort of two-headed dragon where people still put a lot of stock in what Yellen says, and she's obviously speaking on behalf of the administration, but she's not speaking on behalf of the central bank. So you don't want to see any differences between the two. And the previous time that Yellen spoke, of course, on inflation, that was we saw markets really move on that. So I think this is a worry for markets, but it is also just an admission that the grown-ups in the US know that inflation is coming and that it's maybe transitory, but at the same time we are seeing the wage pressure coming through, and that's not the same as higher oil prices. This is something that can be sustainable. So therefore, I think she's probably just stating the obvious that at some point, inflation is picking up, and at some point that might mean higher rates.
Eddie, I know what you're also exceptionally good at is finding things in the markets that, will play out in the next couple of weeks that no one else has really seen. So are you looking at commodities? Is there another space? Is it currencies? Is there another space in the market that is of exceptional value right now?
That's the biggest compliment you've ever given me, Francine. Thank you. I don't know if that I can back it up.
Don't let it get to your head. You still have to pass.
I'll tell you one thing that I am looking at very closely is this inflation narrative, and particularly the food inflation. If that's starting to hit emerging markets who are struggling still, with bringing COVID under control. Just as they start to bring COVID under control, they then hit with food price inflation. And remember, they, citizens in the developing world has not had the same support from their governments as those in the developed world. And historically, we have seen things like food riots. We've seen real trouble in emerging markets. If food prices become too high. So I think, we saw canola over the weekend or at the end of last week hitting a record. I think that's something that I worry about right now.
Eddie, thanks so much. Eddie van der Vaart there from our Markets Live team, and hopefully we'll have regular updates from Eddie to see any insights changing. Now, coming up, Armin Laschet boosts his chances of becoming Germany's next chancellor in September after seeing off the far right in state elections. Up next, we discuss that with Berenberg's chief economist, Holger Schmieding. If you have any questions for him, please, IB Plus TV Go. This is Bloomberg.
The G7 is, 7, and there are plenty of other countries out there. Now, you may assume that with some of the biggest other countries, they've probably done some pre-cooking of this. But it will be hard to get it through both in Europe and more broadly, because there are some countries, Ireland being one, which have made considerable play of their low tax environment. And that's going to be a bigger change for them than it is for the UK. So there is quite a lot of work to be done, but it is significant.
Well, that was the NatWest chairman, Howard Davies, speaking to us earlier about the G7 tax deal. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Qantas has asked Australian authorities for details of a report which suggests it has been infiltrated by organised gangs importing drugs. Local media say the report found as many as 150 of the airline's employees could be linked to organised crime. Qantas calls the claims disturbing and says it follows government vetting procedures. Now, a consortium of private equity firms has reached an agreement to buy Medline Industries in one of the biggest leveraged buyouts of all time. Sources say Blackstone, Carlyle Group and Hellman & Friedman will take a majority stake in the medical supply company in a deal valued at more than $30 billion. Singapore's GIC will also invest. Bloomberg has learned that KKR is close to reaching an agreement to buy Atlantic Aviation from Macquarie Infrastructure. The deal could value the airport services company at about $4.5 billion, including debt. Atlantic Aviation offers hangar space, aircraft maintenance, and other services. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Now, Armin Laschet boosts his chances of succeeding Angela Merkel as German Chancellor. The CDU party has secured a decisive victory in the country's poorest state. The win in Saxony-Anhalt gets his campaign back on track after his leadership of the CDU got off to a rocky start. Well, joining us now is Berenberg's chief economist, Holger Schmieding. Holger, great to speak to you. I know you're a great student of German politics and the CDU. So what are the chances that Mr. Laschet becomes Chancellor at this point?
Mr. Laschet will likely be the next German chancellor. I think he has a probability of, say, 55% of making it. The Greens still have a chance. Their leader, Annalena Baerbock, I would say 40% probability of being the next chancellor. And there is a residual 5% for the SPD candidate, the current finance minister Scholz. But Armin Laschet is ahead, and yesterday's state election result will probably help him to unite the CDU and its Bavarian sister, the CSU, behind him for what will be an interesting, vigorous campaign in which the CDU and Laschet will likely prevail in the end.
Holger, if there's anything that actually Mr. Laschet can learn from the mistakes in the early days, what are they? I mean, I keep on hearing, he's not the most charismatic. It's not, maybe he can't get through or cut through to the voters like Angela Merkel did. Will he change in the way he communicates, or can he do anything about it?
Well, I don't think he really made that many mistakes in the early days. What bogged him in the early days was the hype about the Greens and their leader, Annalena Baerbock. There wasn't much he could do about that. And what we now have as a situation is that the Greens, who briefly surged to the top of opinion polls after picking Annalena Baerbock in mid-April, that the Greens are coming under much more scrutiny. What do they actually stand for beyond the lofty goal of stopping climate change? How do they want to achieve it? It is now much more a debate about the ways and means how to get there. Almost everybody agrees, including the CDU, that more needs to be done to stop climate change. But in the debate about how to actually get there, the executive experience of both Mr. Laschet and of the CDU in general counts significantly against the Greens, which have much less experience with that. And as a result, the Greens have been a bit deflated in the debate and in the vote yesterday.
Holger, vaccinations, of course, are crucial. We saw it here in the UK. If people get vaccinated and can go back to normal, it can be a very big boost for the party that has, of course, control at the moment. How's it going in Germany? After, it feels like, sitting in London, after being behind, actually the inroad has been quite significant, and it could be even better than what we're seeing here in the UK in terms of vaccinated population.
Well, the vaccination rate in the UK has been higher and is still higher, largely because the UK has imported a lot of vaccines from the EU without exporting any noteworthy amount back. So in a way, thanks to the generosity of the EU in exporting vaccines, the UK has been ahead. But what we are seeing is that the EU is catching up. It is still behind in vaccination. But we are currently at a situation where the infections rate, the number of recorded new infections per day in the UK has risen, whereas in the EU it keeps falling, and in the Eurozone and the UK, the infections rate is now roughly the same, with the trend being adverse in the UK. In short, what we are having is on the European continent, after a slow start to the vaccination campaign, significant progress, with Germany being among the better performing countries in the EU. And that will, of course, help to dispel some of the anger against, all the restrictions that has been feeding a bit into support for the far-right AfD, which, with vaccination progress and the COVID situation getting very much under control, knock on wood for the time being in Germany, the AfD did less well in Saxony-Anhalt, the right-wingers, than expected, partly because this issue of COVID remains a big issue, but is no longer as big an issue as it was a few weeks or months ago.
But can you tell us, Holger, the state where actually the heir to Angela Merkel did pretty well, is it a template for the rest of the country, or is it quite different just because of the economics of it?
Well, the state is, of course, different. It is small. It is split into two sort of metropolitan areas and a lot of more rural areas, small cities, where the AfD is doing well and still does well. But we see in the state two things. First of all, when it comes to actually casting the vote, then people do value continuity, stability. And, Merkel is no longer running. But Mr. Laschet has been called, rightly so, the continuity candidate, the man with policies not that far from Merkel. And Germans, with the economy being very much on the mend, the COVID situation sort of getting under control, once again, knock on wood, the Germans probably don't really yearn for change. They voted heavily for the incumbent in Saxony-Anhalt, and I expect the CDU-CSU, that is Merkel's party, to prevail at the federal election in September, because the Germans don't really want that much change. Despite a little bickering here and there, there's always a little thing to be unhappy about.
Holger, thank you so much. Berenberg's chief economist there, Holger Schmieding, joining us on Germany. Now, coming up, the UK Health Secretary Matt Hancock says it's too early to say whether restrictions will ease further on June 21st. Meanwhile, Boris Johnson risks a parliamentary defeat over his plan to cut overseas aid. We get the latest from the UK next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the UK Health Secretary Matt Hancock says it's too early to say whether the planned easing of coronavirus restrictions will go ahead on June 21st. This is after a rise of the Delta variant first identified in India. Now, removing the last batch of restrictions would allow nightclubs to reopen, sports stadiums to fill to capacity, and large weddings and conferences to resume. Meanwhile, the UK Prime Minister Boris Johnson risks parliamentary defeat today on his plan to reduce overseas aid. Now, this could be a potentially embarrassment for Johnson ahead of the G7 summit this weekend in Cornwall. Now, let's get more on all of this with Therese Raphael, Bloomberg opinion columnist. Therese, great to have you on this Monday morning. Now, is Boris Johnson actually heading for a defeat in the Commons over international development aid?
Well, conservative rebels think they have the numbers, and government whips are clearly concerned. There are various ways the government could avoid a defeat. It could get lucky if Lindsay Hoyle, Speaker of the House, doesn't rule the amendment in scope. The amendment requires this newly established body, the Advanced Research and Innovation Agency, to make up any shortfall in the 0.7% of GDP foreign aid target that the Tories promised in their manifesto. It's unlikely, it seems, at this point that he's going to not allow the amendment. So then the government could agree a compromise with the rebels. It could promise to, say, go back to 0.7% next year, or they could find some other way through. But at this point, it looks like the rebels are going to demand more assurances than just simply a sort of vague pledge to make it up in the future, and the government doesn't want to be tied down. So it looks like it's going toward a showdown at this point.
So why is this a red line issue for some Tories, given that increasing the foreign aid budget is not popular with the public?
Yeah, it's a really interesting dynamic, because not all of the opponents to this 0.5% are opposing for the same reasons. So you have the China skeptics who see it as hugely important that the UK and other Western countries are engaged in developing world affairs. They worry that China, as recent years has shown, will come in and fill that breach if they don't. They see, Boris Johnson has a huge opportunity at the G7 this week to make a stand and project British leadership on multilateral efforts in the developing world. So they see that 0.7% pledge as part of that. Other MPs just object to the idea of the party breaking its manifesto pledge, even though it would hardly be a first time for that. And, then there are others that just want to hold the leaders' feet to the fire and show that the Treasury is going to have to, bend to the will of the backbench sometimes. It can't always have its way. So there's a mix of motives in there.
Thank you so much, Therese Raphael, there with the very latest, of course, on what's happening in the UK, and then we'll see whether all these big events can actually gather. Therese Raphael from our Bloomberg opinion team. Now, let's get straight to the markets, because there is quite a lot going on. Remember, it's also ECB week, so watch out for that. That's on Thursday. We have a great Bloomberg story that just hit the terminal, saying that the ECB has far worse troubles than inflation. Of course, inflation dominating markets today. If you look at U.S. equity futures dropping, treasuries dropping, investors weighing inflation risks and the impact of this minimum corporate tax on technology firms. The dollar, though, ticking higher. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me from Berlin. Our Elise Abramovitz actually joins us from New York. We'll have a full roundup of this resurgent inflation, again, sparking this debate about when the Federal Reserve will start tapering monetary accommodation. This is Bloomberg.
This is progress, historic progress. Progress that's pulling our economy out of the worst crisis it's been in 100 years.
This is a positive report. Certainly, I would love to be able to stand here and say 7 million jobs came back, but unfortunately, that's not how the economy works.
There's no, hardwired deadline. We are doing the work of legislating. This is a big week.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
Well, good morning from London, Berlin, and New York on this Monday, June the 7th. Our top stories today are higher interest rates on the way. Well, Janet Yellen says they would be a plus for society and the Federal Reserve. Targeting the tech giants, the G7 agrees to impose a minimum tax on multinationals like Facebook and Amazon, but the agreement could take years to implement. And crypto's getting crunched, while Bitcoin and other top digital currencies fall on concerns that there may be another crackdown in China. Well, good morning, everyone. Happy Monday. I'm Francine Lacqua with Matt Miller and Lisa Abramovitz. Kailey Leinz is off today. Now let's get straight to the markets. It's all about inflation and taxes. Matt, what are you looking at?
Yeah, absolutely. I mean, there's a huge central bank focus today, Francine, but the tax issue is moving a lot of markets. Take a look at what's going on in Asia, for example. We have a big drag on the MSCI Asia Pacific and on really Hong Kong's HSI index, and that is Tencent really pulling down, and any of the big digital, global corporations that could be hit by this global minimum tax, even if it takes years. You've got some areas of Asia not doing much at all, some areas doing well. Singapore, for example, is looking at some gains right now. But look at the bottom of this chart, Tencent down 1.8%. It's a very heavy stock. So Tencent is a huge drag, but you're also seeing Alibaba and other big digital corporations getting hit by this concern. In Europe, we have a different concern, and that is a delay of the reopening. If you take a look at the indexes, there's not a lot of movement. Here you can see from the world map that we have a lot of gray on the map. So that means not a lot of movement to the upside or to the downside. But you do see individual companies, for example, IWG, right at the bottom of this chart. A lot of people won't know IWG by the holding company name, but they operate Regis and other flexible workspaces. As a result, they are down big time. They said the reopening isn't happening quickly enough, and they get almost half of their revenue from the U.S. They're traded in London, of course, and they have a lot of office space in Europe and in the UK, but they're saying, look, the delay is taking longer than we had anticipated. It's going to push out a rebound in revenue, and that is a real problem, a real concern across markets. Lisa, what are you seeing in the U.S.?
Not a lot, which is, I actually think, very interesting. The idea here being that people are expecting there to be some sort of decline in the big tech names as a result of the tax agreement. You are not necessarily seeing that. I find that interesting, Matt. If you take a look at what we're seeing across the board, we can see that it's down a little bit. The S&P is down about 0.1%. Not significant if you consider the incredible potential for these tech companies to get taxed. Also, you're seeing a bit of a reversal from what we saw on Friday after that disappointing jobs report, a little bit of a bleed higher in yields, in 10-year yields. Also interesting, crude coming off its highest levels since October 2018. This expectation that perhaps demand isn't as hot as people expected. My key question is, how quickly can U.S. supply come back online? OPEC Plus saying it has the upper hand and it can take control. The question is, can it really? And Bitcoin, a volatile weekend session, as it is wont to do. There was a question of China cracking down. Weibo on the social media platform talking about possibly removing or banning certain sites. They do not want another Elon Musk over in Chinese social media whipsawing this currency. However, we seem to have found some stability, Matt. Fran? What are we looking at this week ahead?
Yeah, I mean, Bitcoin is definitely the big one, steady at 36,000 after the pretty crazy roller coaster ride that we saw in the last 10 days. Now, these are some of the events that we'll be watching out for in the week ahead. Apple holds its annual Worldwide Developers Conference today to announce new hardware and software. Then the World Trade Organization meets tomorrow to discuss expanding the production of COVID vaccine facilities. We'll also get a Bank of Canada rate decision on Wednesday, followed by an ECB rate decision on Thursday. And of course, the big one, the G7 Leader Summit starts in Cornwall, England on Friday. And as Lisa was saying, it's interesting to see not that much is changing on the markets despite this historic deal on, of course, tax. It could take years to put in place. Now, Treasury Secretary Janet Yellen has also weighed in on the inflation debate. In an interview with Bloomberg, Yellen said that if President Biden's spending plans lead to slightly higher interest rates, it would, quote, actually be a plus for society's point of view and the Fed's point of view. Now, let's get more from our Bloomberg MLive editor, Eddie van der Walt. Eddie, he's back and he's looking at inflation. The concern, Eddie, is that actually it's confusing because, usually finance ministers don't weigh in on central bank matters.
Absolutely. But you know what? I think she makes a really good point here. I think most central bankers would like to see interest rates a little bit higher. They'd like to see inflation a little bit faster. They'd like to see a normalization. And I think some of that, it's true also in Europe. We haven't got a strong voice like Yellen, perhaps, outside of the ECB saying it. But I think it would be a positive, and the European banks are clamoring for it. Now, European banks today are slightly higher, and it is on this expectation of inflation rising and a steeper yield curve, which benefits them because, of course, they lend at the long, at the long end, and they borrow at the short end. So that's really interesting dynamic, and I think she's absolutely nailed it on the head. Whether we get to see that, in the months coming up, that's another question altogether.
What do you think about Bitcoin? Is $36,000 the new normal?
I tell you what, Matt. If we stabilize here, right, below at 36, after that run that we had last year, it would be a significantly different story than we had in 2016, 2017, when we had a parabolic rise and then a crash by 80% or more. We're less than half. Below the most recent peak. So if we can stabilize here, Bitcoin remains an extremely volatile asset, but it just shows that the volatility over time is starting to abate. But we're not quite out of the woods yet. So let's give it a few more months and see.
Eddie van der Walt, thank you so much for all of your coverage on this. Meanwhile, over the weekend, the key news really was that G7 nations have agreed to revamp their tax rules, including a minimum corporate tax rate of at least 15% on foreign earnings. A landmark deal. It may help countries collect more revenues from big digital firms. UK Chancellor Rishi Sunak hailed the agreement.
I think the crucial thing for people to take away is the principle of fairness. That's what we've achieved today to ensure that there's a level playing field for all types of companies. And whether it's people operating in tax havens or it's digital companies, we're going to level the playing field and inject that principle of fairness into our global tax system.
Bloomberg's Maria Tadeo in Brussels has been covering all of this. Maria, what are the details here?
Well, this is something that is being hailed as this tax revolution, as this new tax system for the 21st century. You heard it there. This is about paying a fair amount and a level playing field. So we do have a deal on two fronts. One, of course, is on the rate. That's 15%. And the other one is this principle that would now allow countries to tax digital companies in the place where they make and provide their services. Now, a lot of the criticism had been for years that they were flipping profits to low tax jurisdictions. So this should put an end to that. The problem here is the implementation, and the implementation risks are still very high. We're talking about the G7, but then this needs to go to the G20 and we'll also have to go to the OECD. At the same time, you could see that there will be countries such as the Irish who would push back against this because they're very competitive on the tax, and also from a legal perspective, it could take years for it to be applied. So it sounds great on paper, but the implementation risk around it are still very high.
Yes, so Maria, this could take years, and at the same time, it could actually, not go beyond the G7. So what does it mean for these big tech firms? Have they even weighed in on the debate?
Yes, Francine, and they did so very quickly and perhaps more positively than we were expecting. Of course, no company likes to pay more taxes, but to some extent, this is a long time coming for digital companies. They've known for a while, particularly in Europe, the governments would want them to pay more and want to pay more nationally. So they did say and commented that this is a good deal if it means there will be a clear tax system and that those tax rates will be clear across the world. For them, it's better to pay just one amount than many different national regimes. So that's the upside for a digital company like this, even if that bill could go up.
Bloomberg's Maria Tadeo, thank you so much for all of the reporting. Let's take a look at some of the stocks that are moving in pre-market trading in the United States. I want to take a look at AMC. Interesting to see it's up 4% in pre-market trading here, and this comes as the Russell 2000 thinks about possibly kicking it out of that index, bringing it up to the Russell 1000 because it's gotten so big. I am interested to see how this affects the composition and really how this affects the discussion around the meme stocks and their effect, shall I say, on some of the index stocks. Next up, Tesla, one of the Bitcoin proxies, which has been whipped around. Also some concerns about longer-term production. Tesla definitely becoming and acting increasingly like a crypto asset, down 1.7%. The key question is how volatile it will get throughout the session, or whether people are actually just increasingly using it as a mainstay. And then last but not least, we are definitely interested in watching Apple. This is as the Worldwide Developer Conference kicks off, but also as a number of people have been talking about, potentially one of the companies most affected by the minimum tax rate throughout the world. We're not seeing that big of an effect on the price. I find this interesting, Fran. Basically, we've had this potential for some of these companies to see tax rates surge by significant margins. Very little action in the stocks. What's that telling us? To me, anyway, Fran, that's saying that people don't buy that this is actually going to go through as proposed, and potentially could take some steam out of President Biden's wish to get the tax rate up to 28%.
Yeah, I spoke to Sir Howard Davies, of course, the chairman of NatWest Group, and Lisa, he was saying that, look, this could take years, and it's very difficult to see this going beyond the G7. So I guess what we'll see in the next couple of months if it does get more traction or not. Now, coming up, we'll talk taxes and inflation with Freddie Lait, Latitude Investment founder and chief investment officer. And then a little bit later, we also speak to the new OECD Secretary General. He's Matthias Cormann. That's at 7:30 a.m. in New York, 12:30 p.m. in London. And this is Bloomberg.
The G7 has taken significant steps this weekend to end the existing harmful dynamic, making commitments today that provide tremendous momentum towards achieving a robust global minimum tax at a rate of at least 15%.
That was U.S. Treasury Secretary Janet Yellen speaking on the G7's landmark tax agreement. Joining us now is Freddie Lait. He is CIO and founder at Latitude Investment Management. And Freddie, a number of your top 10 holdings, I'm thinking about Google, and I think it makes up almost 5% of your fund, could be meaningfully affected by this change if it is ever agreed and enacted on a wider scale, of course. What's your view on a global minimum tax?
I think anything that simplifies tax on a global basis is probably a positive. But as someone said on the show earlier, no corporations like paying higher levels of tax. But to a degree, a simplification of business and being able to make business decisions around operating performance and likelihood of growth rather than tax regime is probably a positive for building out businesses that are established and those in the future. And I think, the reason why we're not so concerned about some of those stocks like Google and Alphabet, is that, this is a meaningful impact. If their tax rate went up to 15%, it would be, a 10% hit to all future earnings, whatever, something like that. But it's probably going to come in a few years' time. We're not even sure if it's going to be beyond the G7 at present. There are probably some other things to mitigate it, and we still believe the businesses are undervalued. So I don't expect a huge share price performance move on the back of it.
We do see at least knee-jerk reactions in Asian stocks today. I noted earlier that Tencent, for example, is taking a 2% hit today. It's not, massive, but they're a very big company. In terms of the other big holdings in your fund, you have, huge multinational corporations, but not so digital in nature. You have Coca-Cola, for example. You have Sony, Diageo, Heineken. Are investors only going to worry about the internet platform companies here, or is it all global corporations that we should be watching closely?
I think it'll apply to all, but there will obviously be some where it's a positive as well. I mean, even businesses like Coca-Cola have had a tax issue, so they've had issues with where they've been booking profits, and there's a sort of amount held on their balance sheet at the moment for a large settlement that's going through with them because they're effectively becoming more and more of an IP and advertising business, and the actual manufacturing being pushed out to the bottlers. So it's hard to know where they generate those profits, and actually making it a level playing field so you can distribute your team internationally, your global team of development, R&D, innovation, and marketing, knowing that you're going to be taxed on a fair basis, I think would allow you to scale and move the innovation around the world in a truly global business like Coke. in a much more positive way over the next few years. So I don't see it as a negative for them. I think given the lower tax rates that are found in the digital businesses and the fact that there's so much arbitrage which has been going on with where you've booked revenue versus IP and things like that, they are going to be the most affected. But it doesn't surprise me that Tencent's down sort of 2, not 10% today. A tiny bit taken off the value, but not a huge amount in the grand scheme of things.
Freddie, overall, we had a pretty good earnings season, but how much pressure are we going to see on margins going forward?
Yeah, we've had an incredible earnings season. I mean, businesses that were already doing well have sort of upgraded earnings estimates for the next few years by sort of 10, 15%, certainly many of the names that we're invested in. And I think that was a surprise to some. The scale of it was a surprise to us too. But every call we've listened to for the last few months, they've talked about input cost inflation. And I think margins will therefore be a function of, we know input costs are rising, whether that's wages, distribution, underlying products, raw materials, commodities. It's your pricing power on the other side. So, margin is obviously the difference between the two. And I think focusing on those businesses, which we always do through cycle, whether there's inflation or not, where you believe they have the power to reprice the end customer, whether that's a consumer or another corporate customer, to take into account that input cost inflation. I think those businesses will survive and thrive in this environment. And those that get their margin squeezed could see a really difficult period of stock derating, volatile earnings, and becoming kind of trades around commodity or input cost proxies as opposed to the underlying operating performance.
Freddie,
so I think it'll be a tale of two halves. Sorry.
How does that look? No worries. How does that look in terms of the performance? I mean, does this just mean that some of the companies with less pricing power underperform, or does it mean that there's actually a drawdown in markets and that the companies that you're going toward are kind of the safe havens within equities?
So there's a lot to unpick in that question. I think it will drive margins lower, probably in aggregate. And it's therefore very important to buy into those businesses where you believe that the margins can be held or increased from here. And that generally is a pricing power and sort of position in your industry argument. There is also a meaningful risk that if inflation and interest rate threats or even threats of interest rates comes back, that the whole market takes a hit and derates downwards. And I think that is probably the greatest risk to investors at the moment. And to the third part of your question, does that mean you hide, if you like, in the safe havens, which maybe you can't balance off those two risks, because there's one risk of margin, pressure, and some very high quality pricing power businesses are out there, but they trade at very high multiples. And so you're at risk of the second impact, the second order impact of inflation. And so we believe actually you need to be looking at very high quality cyclical businesses and some of the more value stocks out there, which we would argue really truly can be as high quality as these defensive businesses, but come at literally a fraction of the valuation to get your portfolio valuation down to a level which you feel makes it far less susceptible to that second risk.
Freddie, thanks so much. Freddie Lait, their Chief Investment Officer and founder at Latitude Investment. Now, coming up on Balance of Power, Ray McGuire, former city vice chairman and New York City mayoral election candidate. He'll have a thing or two to say about buses, transport, and of course, climate change. That's at 12:30 p.m. in New York, 5:30 p.m. in London, and this is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Lisa Abramovitz in New York. Kailey Leinz is off today. Now let's get straight to the Bloomberg First Word News. And in China, the trade boom continued last month. Exports grew almost 28% in dollar terms from a year earlier. Now that's weaker than forecast and below the pace in April, but it's still well above historical growth rates. Meanwhile, imports soared 51%, boosted by rising commodity prices. Now in Germany, Armin Laschet has boosted his chances of succeeding Angela Merkel as chancellor. In the final electoral contest before September's national election, Laschet guided the Christian Democrat to victory in the country's poorest state, Saxony-Anhalt. Well, the outcome will help ease doubts about his suitability to lead Germany's conservatives. And in Mexico, President Andrés Manuel López Obrador's party took the lead in midterm elections for the lower house of Congress. A survey, though, indicates his coalition won't retain a supermajority needed to pass the constitutional reforms. In Peru, the presidential runoff is still too close to call. Investor favorite Keiichi Fujimori trails leftist Pedro Castillo. Fujimori is the daughter of a jailed former president, Alberto Fujimori. And it would be one of the biggest leveraged buyouts of all time. A consortium of private equity firms reached an agreement to buy medical supply company Medline Industries. Well, Bloomberg's learned that the transaction is valued at more than $30 billion. The consortium include Blackstone Group, Carlyle Group, and Hellman & Friedman. Proceeds will flow to the Mills family, who will keep their leadership roles at the company. And Matt, you alerted me actually to the story as soon as I came in. It's one of our most read stories because the Mills, I didn't know who they were actually, and it wasn't obvious that they're one of America's richest families.
Yeah, and I was kind of hoping like someday I'll find out that my family has a business that I didn't realize we had, and it makes us into instant overnight billionaires. It's kind of been a pipe dream of mine.
What was interesting to me about this story, Fran, was the idea that this is the company that made the swaddling blankets that are ubiquitous across America. The sort of striped
I
ones.
love those.
I didn't know that.
Very
I
important.
didn't know either.
Fun
and
fact
I didn't
of the
know they
morning.
were worth $30 billion. Coming up, Mathieu Savary, BCA Research Chief Strategist. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Lisa Abramovitz in New York. Kailey Leinz is off today. Matt, a lot of the focus, of course, is on, that inflation that will spark debate, with Janet Yellen once again talking about interest rates and what would help the Fed or not. I had an interesting conversation with Sir Howard Davies saying the messaging from the U.S. right now is just confusing.
Yeah, well, and we saw an interesting piece by Bill Dudley saying that it's dangerous to the economy because it's not only the inflation target that they've set, but they've also pointed out that they're going to keep rates at a low until unemployment is back down. And all of these things together could cause massive volatility when they have to turn around and raise rates further. The question, though, the basic question still is whether or not this inflation is transient, right? Do you believe it's transient, or are some of the price increases here to stay?
Right, and that's been the debate over the last couple of months. And Lisa, that's obviously playing out in the markets, but they're still confused, I guess, the markets about how to price in this like tax increases.
Well, Francine, this is where I wanted to go. This idea that we're getting such huge potential changes, yet such little drama in markets. And this has been a theme for the past number of weeks. The idea that we've gotten, proclamations from key officials. We could see runaway inflation. We could see policy errors. We could see higher tax rates. We could see huge fiscal stimulus. Markets, no drama. If you take a look at what's going on in markets globally, you are seeing a bit of a sell-off reverse. Now all of 0.01% increase in the Stocks Europe 600. This idea of no drama is pervasive, even with the tax proposals. Yes, you're seeing tech names lead the way down in the United States ahead of the open, and yet not very much, leaving the S&P futures down just 0.25%. Meanwhile, 10-year yields taking up just a little after that decline that we saw on Friday after a disappointing payrolls report. People wondering how much inflation could potentially key up given the potential for a policy error like Bill Dudley was saying, as Matt mentioned. And then Bitcoin down now 2.1%. Check us back in a half an hour. It might be completely different, Matt.
I think it is pretty dramatic, though, Lisa, that Bitcoin trades for $36,000. I mean, even though it's down from an earlier high, it's still an asset that, was going for $3,000 a couple of years ago and $3,000 a few years before that.
We know you got in on the bottom. Congratulations. You won this one. And you're right, $36,000 looks pretty good if you got in at $3,000.
I was just also thinking.
Password.
Yes, I wish. If I could remember its password, my password, I would have a Lamborghini Aventador. I want to point out something right now. Aventadors have gotten a lot more expensive recently, as have many other goods. We're looking at the surge in U.S. inflation here, and for those of you listening on London DAB Digital Radio, we welcome you. I'll walk you through this chart. What it shows is PCE, core PCE, so minus food and fuel, but including Lamborghinis, going back to the 90s. We're looking at the kind of spike right now that we haven't seen anywhere else on this chart over the last year. Core PCE has just shot up, and it's also up to the highest level that we've seen since 1991. That was the year that I dropped out of high school. So it's been a long time since we've seen these levels. You also have here the Fed funds target, and it just flatlines over the last 2 years, obviously during the pandemic, at a low of between 0.25%. So it's interesting to see core PCE spike like this and nothing happen, Fran, on Fed rates.
Yeah, I think, Matt, you're much younger than you let on. Now, higher interest rates could be a plus for the U.S., according to Treasury Secretary Janet Yellen. Earlier, we spoke with NatWest Chairman Sir Howard Davies about his view on the inflation debate.
I think the U.S. Are being a bit confusing here. And I think it would be good if we heard one message from the U.S. Because on the one hand, you've got Janet Yellen actually saying, well, maybe a rise in interest rates would be a good thing. And as a banker, I could hardly disagree with that. That would actually be quite positive from a bank's point of view. On the other hand, you've got the Fed saying, well, we are going in future to adopt an average inflation approach. It's not the same as what Janet Yellen is saying, because what the Fed is saying is we may not raise rates and allow inflation to be higher than the target for a period. Whereas she's saying, well, higher rates might be a good thing. So I do think this is a bit confusing for the market at the moment, and it would be quite good if we had one consistent message from the US.
Well, joining us now is Mathieu Savary. He's Chief Strategist at BCA Research. Mathieu, thank you so much for joining us. When you look at the European Central Bank and also some of your calls on European assets, do they have bigger fish to fry than the inflation debate?
Yeah, thank you very much for having me this morning. Yes, indeed, you're absolutely correct. They do. Right now, there is still a lot of uncertainty regarding the European economy. We're seeing a nice uptick taking place because the global economy is strong, because the vaccination campaign has picked up considerably in Europe. But nonetheless, we still don't know exactly how fast the European economy will reopen in the second half of the year. And moreover, the ECB is conducting its strategic review right now, which means that there is really no urgency until this is conducted to adjust policy right now and weigh into that inflation debate for now.
So, Mathieu, why do you like European assets right now? For a long time, or for most of 2020, they were kind of on the back foot.
Well, there is a multitude of reasons. The first one is simply the fact that despite this uncertainty right now, the stars have lined up quite well in favor of the European economy. There is still a lot of pent-up demand in this economy, and the eventual reopening will definitely boost economic activity in Europe, which will have a positive impact on domestic play within European assets. And secondly, the general environment, which continue to favor higher yield over the next 12 to 18 months, which continues to point toward a lower US dollar and higher commodity prices, is consistent with a further outperformance of value stocks relative to growth stocks, and particularly sectors like industrials, materials, energy, and to a certain extent financials. And Europe overweighs those sectors compared to the United States. So from a sectoral perspective, Europe is well positioned. Finally, in a context of a depreciating US dollar, the euro looks good.
You talk about the risks to your thesis, and the one I find really interesting, Mathieu, is a potential deterioration in the global credit global credit impulse. What exactly do you mean by that, and how could that be brought on?
Okay, so it's actually the credit impulse is the change in credit flows, because ultimately what matters the most for economic activity is just that. It's not just the stock of GDP, it's not even credit flows per se, but what will determine growth from one year to the next is how much those credit flows are changing. And last year we did see a pretty strong pickup in credit flows as companies around the world in particular geared up for potential period of illiquidity and essentially borrowed a lot of money. Now, what we are seeing is that the credit flows have stabilized, which means that the credit impulse has deteriorated massively. In fact, very near-term credit impulses are quite negative. Then there's the Chinese economy. We know that Beijing is trying to protect essentially financial risk in that economy. And we've seen a sharp deceleration in credit growth and in the Chinese credit impulse, which historically brings about a strong deterioration in industrial activity and global trade. There is reasons this time to think that the deterioration in global trade will be smaller than normal because there's so much fiscal stimulus in the system. But nonetheless, this lineup of factors suggests that we could see this deterioration in the credit impulse. So this is worrisome because historically it tends to indicate period where the cyclical spending in the economy, which is financed using credit, tends to deteriorate a little bit. And since Europe is an economy very sensitive to the global industrial cycle, to global cyclical spending, at the end of the day, it exports a lot of machinery, cars, chemicals, and things like that. If this deterioration in the credit impulse really starts to drag down the global economy with it, then European assets, which are very sensitive to global growth, will underperform in that context.
Mathieu, I'm looking, for example, at some data coming out of Europe. Germany in particular, you saw factory orders drop 0.2%. The expectation had been for an increase of 0.5% in data that came out this morning. At what point do you take a look at this data and get concerned versus discounting it as simply noise amid a reopening?
Well, for the time being, when we look at, for example, the surprise index for Europe, it's been quite strong. The aggregate of the data has turned around, and a lot of the data that continue to perform poorly is more backward-looking. When we look at things like the PMIs, the confidence data that, yes, are soft data, but have a much better track record as a leading indicator of economic activity, they are doing very well right now in Europe. So that's what I tend to focus on. But if I were to see a sharp deterioration in new orders to inventories and things like that in Europe, I would get very worried.
Mathieu, thanks so much. Mathieu Savary, their chief strategist at BCA Research, joining us this morning. Now, coming up, consensus on crypto. Well, we'll discuss the role of digital coins after more than a decade of Bitcoin's existence. That's coming up next, and this is Bloomberg.
If you're looking for a safe haven, I see Bitcoin as the most secure, most reliable, most certain thing in the entire economic universe. And if you're looking for some place where you can store your life force or your economic energy, you know, there's no real question.
A fun fact, there's 46 million millionaires on the planet. It's only 21 million Bitcoins, so they won't own a Bitcoin. So if you own a Bitcoin today, you will be a millionaire in the future, for sure. Congratulations.
Everything about it is why we're into it. There's nothing else that compares to it. And we have no interest other than making sure that we are building a native currency for the internet and helping in every way that we can. So all the other current coins, to me, don't factor in at all.
That was Jack Dorsey showing off his latest T-shirt favorings. Right now, we have been looking at some of the biggest names in cryptocurrency, discussing the potential of digital tokens at this turbulent moment. We're going to stay to play for cryptocurrencies with Bloomberg's Joe Weisenthal, anchor of What Did You Miss on Bloomberg TV. Joe, you did a column on crypto out today, and you had a really interesting idea here that we actually have some consensus about what Bitcoin is. Can you explain?
Yeah, I mean, you kind of heard them talk about it right there, this idea of like a safe haven asset. For years, there's been debate, is it a currency, is it a commodity? People, oh, why don't people spend it? Oh, that's a sign it's not really used. That kind of debate's over. Like, people don't really talk about that anymore. There's like this weird consensus that's emerged that it's like kind of like digital gold or something. But in the piece that I wrote out today, it's basically saying like, okay, with that consensus that's emerged for Bitcoin, other things have emerged that are really trying to be something extremely different, and there's quite a diversity now within the crypto world.
Joe, one of my favorite things about your column is the incredible meme art that you quote and how much this has become popularized. How do we know, though? Fine, great, we get it that we definitely have some consensus on what Bitcoin is. When will we have a sense of its staying power? Is it regulatory scrutiny, as we see on an ongoing basis from China?
Yeah, I mean, look, I think there's always going to be probably an evolving regulatory landscape. By and large, I think actually I would say people have been quite surprised at its acceptance. People are like, oh, they're going to ban Bitcoin, or there's going to, some things out of China. But look, take a look at the U.S. Like, it gets more and more accepted as a thing every year. It's getting more entrenched in the financial system. We have the Coinbase IPO. We have institutional vehicles to invest in it. So despite years of sort of assumptions, I would say that some big crackdown is coming, and who knows, the actual facts on the ground seem to have been the opposite.
I love, Joe, some of the very absurd but cool memes that you have in the story. So congratulations on finding them and actually reprinting them. Joe, I mean, regulation, we still don't really know how much of this is money laundering and things like that. So if regulation comes, I mean, could it actually change the way that, Bitcoin is? And does it, does something else like Ethereum take over? Or is it still always going to be there?
Well, that's the thing. I mean, I think if you look at some of these other visions for crypto that are emerging, and you hear a lot about so-called DeFi, decentralized finance, many of these things are perhaps more aggressively trying to taunt or pose a problem for regulators. I mean, there are places you can go now to trade de facto swaps and synthetic equity without any sort of KYC, AML, things that resemble more traditional finance instruments very directly, things that are pegged to existing equity, things that resemble IPOs and things like that, platforms that resemble stock markets. And so I think that the regulatory landscape for altcoins is going to be very interesting, pose novel challenges as people attempt to define what these assets are. But I think we're sort of at the beginning of this, and so far we don't really know what the overall regulatory response is going to crypto writ large, what that's going to look like.
The main meme modern monetary theory? Is that what it was called in your column? Oh, no, Magic Internet Money Wizard, which is kind of the same thing, right?
Yes.
As modern monetary theory. You talk about Bitcoin being backed by nothing, and it reminds me of the U.S. dollar, although I suppose the global oil complex is what backs the dollar.
Well, I mean, also there's a requirement to use the dollar. And even in the United States, I mean, if you want to pay taxes, and this is a really key point, which is that, you have to pay taxes in dollars. So you and I could transact in any currency we wanted over the course of a year, but at the end of the day, I have to pay a tax bill in dollars, so I have to go out and acquire dollars, and that creates a demand for them. What's even more extraordinary about Bitcoin, perhaps, is that there is no requirement, there's no obligation to use it for anything. And so, when we talk about a meme coin, for example, we're like, all right, everyone thinks about Dogecoin or something like that. But my point is, Bitcoin is fundamentally not that different. It's just that the meme is digital gold or the digital money. It's a very powerful one. But really, I mean, it's become, I guess, this, over $500 billion asset, basically based on belief. Some people believe that it's a valuable thing. Some people think that it's a safe haven asset. Some people think that space within the Bitcoin blockchain is a valuable thing. And, there's no use case really for it other than expressing that belief by holding it.
I mean, come talk to me next time your pipeline is being held ransom, Joe, when you think that you aren't required to redeem Bitcoin for anything.
There's something
in terms of the institutional uptake, I mean, we just heard some big names and really, to be honest, some meme-ish names talking about Bitcoin. But it does look like Wall Street is really embracing it as a store of value. I guess that's what your whole column is about. What are the differences between Bitcoin and gold, other than the physical property of the latter?
Well, I mean, I think part of it is okay, so what constitutes a safe haven? And I think historically people have viewed gold as some sort of protection against inflation, or maybe a protection of negative real interest rates, which is how it trades more recently. I think Bitcoin's safe haven properties potentially are different. One of the positives, or one of the sort of things that Bitcoin offers someone, is the ability to transact freely. So I can send it to you, you can send it to me without some third-party government or business saying that we're not allowed because maybe they don't like us. And so I think that there is an element of sort of protection against, free money, so to speak, where it's not so much about the central bank per se, although that's obviously a lot of what attracts people to it, but the idea of authorities saying who can and who can't use the money system, which is a sort of increasing threat, in a digital world. Perhaps Bitcoin offers a distinction from gold in that respect.
Bloomberg's Joe Weisenthal, thank you so much for being with us. It's a great column. Everyone, I recommend you read it. Coming up, we'll continue the conversation on Bitcoin, talking to Skybridge Capital Co-Chief Investment Officer Troy Gajewski about why he expects crypto to rally in the next year. He has a significant position in it. He has had this position for a while. That's at 7 a.m. in New York, 12 p.m. in London, and this is Bloomberg.
Well, this is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin. Kailey Leinz is off today. We're also joined by Tom Keene, co-anchor of Bloomberg Surveillance. And Tom, you have the very first interview with the new Secretary General of the OECD, and it's perfect after the tax deal.
Well, after the tax deal, it really rings true. And this is a very different new OECD Secretary General. Francine, you and I have spent a lot of time with Angel Gurria, esteemed economist, esteemed gentleman from Mexico. Matthias Cormann is Belgian, and he's from Australia. He's from Western Australia in Perth, and he is a finance guy at heart, a really interesting resume. I'm dazzled that the OECD selected Mr. Cormann to provide leadership, and really looking forward to that interview. One of the backdrops he has, besides a new tax deal, we'll touch on that, as Greg Villiers says this morning, Francine, it's a treaty, get over it, and that's a huge hurdle in the United States. Is the inflation surprise? Just quickly here, as we've known from the economic data over the last number of days, the inflation surprise index is up, up, up.
Yeah, and I know you have a great chart, which I'm looking forward to hearing more about. Tom Keene there, co-anchor of Bloomberg Surveillance. Matt, we also have a busy day. I'm watching the Apple conference. What are you watching?
Well, I'm watching the possibility, and this is one of the most read stories in the UK, that the reopening is reclosed again. Just as everyone seems confident that we're getting past this thing, we're seeing a resurgence of cases in the United Kingdom, and that could lead to lockdowns coming back. Which would be a huge problem. I don't think it's really on anyone's radar, and all of a sudden, it's a threat.
Yeah, I'm losing my voice because there was so much anticipation about, events, unlimited people at events reopening. I think, Matt, certainly here in the UK, people are, instead of expecting a lockdown, maybe of easing slower than expected, or slowlier, that's not even an English word, than expected. I'm also looking at the Apple, boosting its iPad features and privacy tools at the developer event. So it'll be interesting to see what exactly they have in store for us. That's a little bit later today. Now, coming up in the next hour, Bruce Kasman, JP Morgan chief economist and head of global economic research. That's coming up shortly, and this is Bloomberg.